faithfully delivering value and interpreting great books from around the world. Hello, this is Sally's Book Talk. Today, we're interpreting the book The Alchemy of Finance, written by the financial titan George Soros. Soros was born in 1930 in Budapest, Hungary, to a Jewish family originally named György Schwartz. His family was middle class back then, but in 1944, when Nazi Germany occupied Hungary, young Soros, not even 14, suddenly faced life-threatening deportation and execution. Thankfully, Soros's father got fake IDs for the family. They changed names and hid, ultimately surviving the ordeal. This deeply ingrained experience profoundly influenced Soros's later investment career. After 122, at 17, Soros went to London for studies and got into the London School of Economics 2 years later. In his junior year, he found an amazing professor as his mentor, the philosopher Karl Popper. From then on, philosophy became Soros's lifelong passion and pursuit. So after graduation, Soros didn't do well in London. In 1956, at 26, Soros crossed the Atlantic to New York with $5,000 earned from helping relatives trade stocks. By 1960, he became an expert in European stock investments on Wall Street. Back then, only about 3 people in the US systematically studied European stocks, and Soros was one. He called himself the one-eyed king in the land of the blind. In 1966, Arnold and S. Bleichroder set up the first Eagle Fund, with Soros as fund manager. The fund started with $3 million. Due to strong growth, the Double Eagle Fund followed later. In 1973, Soros started his own fund company called Soros Fund, showing his name had become a gold standard brand. The fund began with about $12 million, and the management team got 20% of profits. By 1978, the Soros Fund grew to over $100 million. In 1979, their fund was renamed Quantum Fund. On September 16, 1992, Quantum Fund launched the world shocking attack on the British pound, making nearly $1 billion in one day. Oh, because of this big win in the pound attack, Soros was dubbed the guy who broke the Bank of England, quickly becoming a household name worldwide. In the 1990s, the Quantum Fund's assets once topped $20 billion. In January 2015, 84-year-old Soros announced at the Davos Forum that he was retiring from finance to focus on his political and charity work. At the end of 2018, the UK's Financial Times named Soros its Person of the Year for 2018. This paper usually picks based on famous folks' achievements. So how does this investing guru see himself? At an Oxford University Awards ceremony, someone asked Soros how he wanted people to call him. Soros answered, "A speculative thinker with philosophical smarts, straddling finance and philanthropy." So philosophical thinking, this means philosophical ideas. Today, the book we're breaking down for you, The Alchemy of Finance, is Soros's first book written to spread his philosophical views. After this one, Soros wrote about 10 more books, but most just build on this foundation. So, no doubt about it, The Alchemy of Finance is Soros's masterpiece. The first edition of The Alchemy of Finance came out in 1987 and didn't sell well at all. But after Soros became famous in 1992 from the pound attack, this book suddenly became super hot and rare. It got reprinted in 1994 and 2003, selling over 5 million copies globally. Former Fed Chair Paul Volcker wrote in the preface that this book isn't an easy read, but it'll reward you. Yeah, this book doesn't teach you stock trading tricks. It's not a how-to guide, but it helps you rethink the whole financial market through a philosophical lens. Now, it's a must-read in many B-school. It might not give quick wins, but offers lifelong insights. Today, we're covering this book in 3 main parts. Part 1, Soros's Reflexivity Theory. Part 2, Soros's Investment Experiments. Part 3, The Essence of Soros's Trading. First up, Part 1. Oh, when talking about reflexivity, we got to mention Soros's mentor at LSE, Professor Popper. Popper was born in Vienna in 1902, one of the 20th century's top philosophers. He was Jewish too, and his book, The Open Society and Its Enemies, hugely inspired Soros. Soros really admired this professor. In 1982, when he started promoting philanthropy, he established a scholarship named the Popper Memorial Scholarship. Although Soros deeply respected Professor Popper, he didn't accept all his academic views uncritically. For example, Popper believed the same methods and standards could study both natural and social phenomena. Soros held a different view, believing there's a fundamental distinction between the two. Natural phenomena don't change because of your involvement. Like when you're walking on the street without an umbrella on a rainy day, no matter how much you hope for the rain to stop, it won't just because you wish it. You can only find shelter. But in social phenomena, participants are inseparable components, and events lack independent development. For instance, in rainy southern cities, umbrella sellers appear at subway or bus stops during showers. Their business depends on whether people buy umbrellas or wait out the rain. Therefore, Soros argued that different methods should study natural versus social phenomena. On this foundation, he created his unique reflexive theory. Reflexivity means the interactive relationship between participants and events. This interaction manifests as positive and negative feedback. Positive feedback means participants' views influence event development. For example, if home buyers expect rising prices and buy eagerly, prices actually get pushed up. Negative feedback, meaning event development, conversely affects participants' views. For instance, when home prices soar too high, buyers worry about potential drops, which then causes actual price declines. Using reflexivity theory, Soros studied financial market price trends, noting they rise slowly but fall quickly. Uptrends start gradually. They gradually accelerate, then flatten near peaks, taking relatively longer. But when stocks fall, it's swift with steep declines. So why is that? Soros explained with reflexivity. Stock prices depend on two factors, the underlying trend and prevailing bias. In bull markets, rising is the underlying trend. In bear markets, falling becomes the underlying trend. The so-called prevailing bias means there are many market participants, each with their own market perspective bias. After extreme biases cancel each other out, what remains is the prevailing bias. If the prevailing bias is positive, it leads to rising stock prices. Conversely, if the prevailing bias turns negative, it causes stock prices to fall. In the early uptrend phase, market participants recognize the underlying trends slowly, often lagging behind. But when prices rise significantly, the trend gains recognition, strengthening the upward momentum. During this process, the market may fluctuate. Participants hesitate, prices drop, but as long as the prevailing bias holds, the uptrend continues. Later, when stocks peak, participants remain bullish with unrealistic expectations, while the market can't rise further. Finally, the prevailing bias shifts from positive to negative, the trend turns downward, and the market stabilizes only after pessimism eases. In the listening notes, there's an illustration showing this entire process. Soros calls this process the boom-bust sequence, which he often uses to predict financial markets. For example, in the 1970s, real estate investment trusts began emerging. At this industry's start, Soros scripted a four-act play for its coming boom-bust history. Act 1. Initially, unmet housing demand made real estate promising, but developers had limited financing. Mortgage trusts solved this funding problem, starting the industry's self-reinforcing trend. Act 2. Residential construction peaked, making good times for real estate investors. Mortgage trusts grew rapidly in size and number, boosting earnings per share. Stock prices soared. Act 3, competition intensified, a national property surplus emerged, and mortgage trust stocks peaked. Act 4, investors' disappointment triggered a sector-wide devaluation of mortgage trusts, causing their stock prices to plummet. The industry's self-reinforcing process reversed. In the following years, the real estate investment trust industry developed exactly as Soros's report predicted. Moving along, Soros first went long on these companies' stocks, made huge profits, then heavily shorted them after the industry's turning point, earning over 100% returns. Using his boom-bust sequence, Soros captured lucrative opportunities in stocks, futures, and forex markets. For Soros, financial markets were like a laboratory to test his boom-bust sequence's validity. All right, now let's move to part 2, his investment experiment. In 1985, based on the U.S. economy, Soros proposed a boom-bust sequence called the Reagan's Imperial Cycle. The name came from then U.S. President Ronald Reagan. This sequence predicted that during Reagan's second term, stocks would keep rising initially, then hit a turning point from bull to bear market. Soros then decided to run an investment experiment to test his prediction. He divided the experiment into 2 phases. Phase 1, August 1985 to July 1986. Phase 2, July to November 1986. He went long in Phase 1 and short in Phase 2. The stock market. In Phase 1, the strong U.S. economy and surging stocks matched the prosperity period of Reagan's imperial cycle. Soros went all in on stocks, more than doubling his invested capital during this phase. You could say Phase 1 was a huge success for Soros. Not only did he validate his Reagan's imperial cycle, but his capital also grew by 126% in just 11 months. Now in Phase 2, according to Soros's prediction, it should have been the decline period with a weak economy and falling stocks. But the market played a little trick on Soros. While he kept declaring the bull market over, U.S. stocks just kept climbing. Because during this phase, he was mainly shorting and ended up losing 2%. In fact, Soros's predictions all came true eventually, but the actual end of this bull market was later than he expected. The U.S. stock market crash happened in October 1987 after the experiment ended, but it was still within President Reagan's second term. So Soros's boom-bust sequence prediction was correct. He just had a timing error on when the bear market would hit. During this phase, although Soros lost a bit in stocks, he made 14% in gold trades and 40% in crude oil trades, so Quantum Fund's overall performance was still great. Additionally, in Phase 1 of the experiment, Soros also successfully predicted a change in the exchange rate system in the forex market based on reflexivity theory. He caught a big fish. The most thrilling investment record in the book was on September 28, 1985, when Soros wrote, "After last Sunday's G5 finance ministers meeting, I made the biggest profit of my life." On September 22nd, 1985, leaders of the 5 major industrial nations met at the Plaza Hotel in New York and agreed the dollar was way too strong in the early 1980s, so they struck a deal to push it down. This agreement meant the end of the free-floating exchange rate system, replaced by a managed floating system. Soros had actually predicted this change would happen sooner or later based on reflexivity theory. Although he was already heavily long on the yen and German mark, he doubled down and massively increased his holdings, leading to a very fruitful outcome. All right, that's it for Soros's investment experiments. Now, let's move to part 3 and discuss the essence of Soros's trading. We'll cover this in 2 points. First, when Soros spots a trading opportunity, he bets big, not just all in, but with leverage too. In 1992, Quantum Fund launched the Pound Attack, with Stan Druckenmiller as chief trader at the time. Back then, although the British government publicly swore the pound would never devalue. The Bank of England couldn't stop it from happening. Druckenmiller spotted this opportunity and called Soros, telling him why he thought the pound would collapse and what his reasons were, and told Soros he'd already invested $2 billion. Soros asked him, "If you believe all this, why only bet 2 or 3 billion?" Encouraged by Soros, Dr. Miller tripled his bet. With Quantum Fund managing under 7 billion, they used leverage to deploy 10 billion against the pound. Recalling this later, Dr. Miller noted few could bet as big as Soros. That ability to maximize bets and returns is rare. He said, there are thousands who are good analysts, hundreds who can predict trends. But when it comes to acting on information, executing trades, and making the theoretical profits, that narrows to just a handful. No doubt Soros is definitely one of them. After covering the first point, let's discuss Soros's second trading essence, his clean, decisive approach to cutting losses. When a trade goes wrong, he exits without hesitation. After phase 2 of his experiment, U.S. stocks crashed hard in 1987's Black Monday. On October 19, 1987, the Dow plunged over 22%, wiping out $500 billion in market value. Soros had predicted a crash but thought Japan would lead, so he shorted Japanese stocks early. But when the U.S. crashed first while Tokyo stayed stable, Soros swiftly cut losses in Japan. Oh, this exit was painfully expensive. Yet, within 2 weeks, Quantum Fund shorted the dollar in Forex for a brilliant comeback. Despite the crash, Quantum Fund still grew nearly 15% that year. As these cases show, when trades misfire, Soros cuts losses decisively. That when rare profit opportunities arise, he leverages up without hesitation to maximize gains. Soros's fund traded across markets, U.S. and global stocks, bonds, gold, crude oil, Forex, and more. In actual trading, if a long opportunity arises, Soros will go long. If there's a chance to short, Soros never misses it, and this applies to any trading instrument. So, how effective is this approach? Stats show that a $10,000 investment in Soros's fund in 1969 would grow to $2.15 million by 1995. His annualized return over those 26 years was nearly 35%, while Buffett's was only around 20%. That covers the essence of Soros's trading. But in Soros's world, it's not just about trading. He has deep interest and understanding in global politics and finance. In Soros's view, international financial markets are turbulent, major currency rates unstable, oil prices volatile, national debts worsening, all urgent problems needing solutions. These issues are international in nature, so solving them requires international cooperation. Soros proposed creating an international central bank. The bank's task would be to regulate exchange rates and restore orderly fluctuations. Innovative, bold. This could be done by returning to a fixed exchange system like the gold standard, or more boldly, creating an oil-backed international currency. The gold standard means the currency issued depends on gold reserves. For the oil standard in Soros's vision, oil serves as the unit of account for global currency, hence calling it petrocurrency. In 1982, Soros proposed an oil buffer stock plan as a prerequisite for the oil standard. Under this plan, he advocated forming a new international organization to replace OPEC. This new group would include major oil-producing and consuming countries, unlike OPEC, which only has producers. Per Soros's plan, supply and demand sides would negotiate production and consumption quotas to stabilize oil prices. Once the buffer stock stabilizes, oil could become the anchor for international currency. Otherwise, with oil prices fluctuating wildly, oil just couldn't serve as the foundation for international currency. In short, the core mission of the new international central bank is to safeguard global economic stability and development. You could say Soros's ideas go way beyond a fund manager's scope, even outside what a Fed chair worries about. No wonder in the 1990s, Soros was nominated multiple times for the Nobel Peace Prize. Soros calls himself a failed philosopher. He hoped the alchemy of finance would spread his philosophical ideas, but it wasn't too successful. However, he lost in the East but gained in the West. While the philosophy world gave the book a cold shoulder, he won admiration from many investing giants. For instance, Stan Druckenmiller, Quantum Fund's chief trader we mentioned, joined Soros after reading this book. Another example is Paul Tudor Jones, who wrote the preface for the second edition. He's a Wall Street legend who refuses to hire anyone who can't grasp the alchemy of finance. And Soros himself values this book immensely. He said, "This book is my life's masterpiece. After I'm gone, philosophy will be the most important part of my life." I hope you appreciate Soros's well-intentioned efforts. All right, that's our interpretation of The Alchemy of Finance. The listening notes are below the audio. See you tomorrow.